Let me just start. I mean, I know it's not, the most dazzling thing to talk about, but when we talk about senior living and that REIT area, it was actually an area of concern that Huntington Bank flagged for us a couple of weeks ago. For them, it was more specific to long-term care, where they just said reimbursements rates hadn't kept up with inflation. So I am curious about, if there's any places other than self-storage to be in the REIT space right now.
Yeah, for sure. So if you think about the backdrop in the senior housing space, during the pandemic, they lost a tremendous amount of occupancy. So industry occupancy was 90% before the pandemic, and it went all the way down to 75%.
Wow.
So what we think is really interesting about this space and the REIT is there's a massive opportunity as occupancy gained to see pretty outsized organic growth out of the sector. So if you look at the National Housing and Care data in 1Q23, you actually saw occupancy gains industry-wide of about 250 basis points, and you saw rent growth coming through sort of in the mid-single digit space. So when you take a step back and you think about the senior housing recovery, there's really limited ways to play it in the REIT space, and Welltower is one of the few ways to do that. And we are looking for organic growth to drive over 10% earnings growth, which should be twice the rest of the REIT group.
Yeah, I mean, it's kind of the REIT play on healthcare, and everyone knows that, if you feel defensive and bearish, you pile into healthcare, and this has some of those characteristics. Let's go back to some of the main points of concern, which are obviously commercial real estate and to some extent retail and shopping center. What inning are we in terms of pricing that in? Because I thought you made an interesting point here that REITs have more negative news priced into them than the S&P 500. That seems like not an efficient market.
Yeah. So when you think about the commercial real estate market, it's a big and diversified market. We size it at about 11 trillion. And the connection to the banks is that it's a levered asset class. So you have about 4.5 trillion of debt outstanding. If you look at the lenders, about 40% are the banks. And if I double click that 40%, you're going to see that 70% of the 40 are the small banks. So there's no question that the fact that the banks are tightening lending conditions is going to have a negative impact on the commercial real estate market. So I think the reason that the REITs have priced in so much is because the REITs also have leverage. So the market's anticipating potential downside in property values, and that gets magnified in the equity values that you're talking about. I think you are getting closer to the end, but you're not quite there yet, because even though some of the sectors like office have priced in a lot, there's other parts of the real estate market that still have really elevated leverage, that still have maturities coming due, that have not been fully baked in yet. So at this point, we still think there's potentially more downside before it's all clear. Yeah,
and I guess the question just becomes, what I don't want to use a word like contagion, but when we start seeing the banks move as quickly as we are, what does that mean for trading the REITs? What happened in 2008?
Yeah, it's a really good question. The way you want to think about the REITs is, look, there's 16 different subsectors. So there's always some pockets of opportunity where there's very low leverage, where there's really good balance sheet that you could take advantage of. Senior housing was one of the ones that you mentioned on. Industrial logistics is one that we find really interesting. But you do want to be really, really careful about the parts of the market that do have really high leverage. We talked about office initially, but if you look at some of the lodging names, if you look at some of the retail names, you want to steer clear of those because, again, as property values come down, if you have leverage, that's even more downside for the equities.
What's wrong with the lodging names?
So if you think about Pebblebrook and PK, they're trading at about 7 times debt to EBITDA, which is about 1 to 2 turns above where the rest of the REIT market is. And in an environment where you have maturities coming due and you're trying to refinance those assets, you could have some potential downside to both the interest costs and obviously the earnings of those companies.